As they're coming up, I'm going to give you guys a little bit of background information about our panelists. And this is a little bit detailed, but I think it's very important for us to know the extensive experience of the individuals who are up here. So I'll start in, order from closest to me. Glenn McGonnigle is a general partner at TechOperators. Prior to launching TechOperators, he was recently chairman and CEO of Vistascape Security Systems, a leading provider of enterprise intelligent video surveillance software, where he was recruited by the company's board to raise capital and grow the business. He also helped shape President Bush's 2005 national strategy for maritime security. Previously, he was a co-founder and top executive of Internet Security Systems, where he helped raise initial venture capital and launch the business. For 7 years, he led the biz dev team in developing sales channels and ultimately grew the revenues to over $225 million and the acquisition by IBM. Prior to ISS, he was president and co-founder of Data Integrity Services Corporation, an early-stage provider of WAN-based data management services. Please join me in welcoming Glenn. Next is Kevin Green. Kevin is a partner at Valhalla Partners. He has over 12 years of operating, banking, and investment experience with both early and late-stage enterprise software, healthcare, and media companies. Prior to joining Valhalla, he was a principal at Flagship Ventures, a $600 million early-stage venture capital firm in Cambridge. Fantastic. Where he served as a member of the investment team and worked closely with a number of Flagship's portfolio companies. I think one of those companies was maybe ISS, or is that prior?
That was at Goldman.
At Goldman. So there's lots of ties up here, so watch out, guys. Prior to Flagship, Kevin worked for IBM out of Research Triangle Park, North Carolina campus, where he's responsible for establishing, retaining, and growing relationships with IBM business partners across the globe. Prior to IBM, Kevin was with Goldman Sachs for several years in New York and Hong Kong offices, where he executed over $30 billion in equity-linked, and M&A financing transactions. Kevin has an MBA from Harvard Business School, and I believe led, and I don't know if I have this on here, led the varsity swimming team at Virginia. So please join me in welcoming Kevin. My technology is failing. Next up is Gamiel. Gamiel joined Sierra Ventures in 2008, and he leads the business development strategy for the firm. That includes broad outreach for Sierra Ventures. Key elements of the business development effort are formal external advisory boards such as Sierra Ventures CIO Advisory Board, the Sierra Strategic Advisory Program, partnerships with service providers such as angel investors, recruiters, venture banking, and law firms. Serving in the role of business development is a unique role for the venture capital community, and a role they've seen him impact the investment process across sourcing deals, accelerating portfolio company adoption, and successful exits. Gamiel has 20 years of operational roles leading business and corporate development, strategic alliances, indirect channels, and direct sales for companies such as IBM, Oracle, BEA, Sarah, Edify, and Cassett. I might have misspoken that last one. Please join me in welcoming Gamiel. Last is Alex Benik. Alex joined Battery in 2001 and currently works out of Battery's Waltham office. From 2001 to 2006, he was based in Menlo Park. He focuses on investments in infrastructure technologies for enterprise, data centers, and wired wireless service providers. He was named the top cloud investor by GigaOM in 2012, is a co-author of TheWholeStack.com, a blog focused on infrastructure IT. And during his tenure at Battery, he's been involved with several of the firm's investments, including, and I'm going to slaughter half of these, very, very impressive companies, a number of which were acquired and are now publicly traded. So please join me in welcoming Alex. All right, well, I'm going to take a seat and we'll go ahead and get started. So the first of our questions, and these are not necessarily the easiest of questions, or maybe they might seem easy because these guys, I'm sure, are very skilled in answering them. So we'll start with a tough question for our panelists. Replacement of founding CEOs. I've heard that roughly, and I'm coming from the entrepreneurial side, part of my goal in wearing a t-shirt was so that I wouldn't be confused. We could clearly signify the different sides of the table.
Take off your jacket.
So it's obvious that many of the founding CEOs are strong technologists and might not even desire to lead a company once significant capital has been injected. There are other cases where they might want to stay. Please tell us about, your most painful and, let's say, amiable experiences in having conversations with those founding CEOs. Maybe anyone who wants to lead on.
I'll go first. I don't think there's any pleasant experience involved. I mean, most CEOs, well, my rule of thumb is if I'm going to invest in a CEO, I have to be willing to quit my job and join the team, which by definition means you're in love with the founders and what they're up to. I mean, if you look at any of the biggest successes, it comes down to one thing, which is people and the team. So in my experience, many of the founders that I've worked with, and this is the conversation you have up front, first and foremost, their job is founder, not founder and CEO, but founder. And you have that conversation, and I think everyone recognizes that we're all human, and at some point, folks can hit their ceiling. There's only a few in the world, frankly, that have gone the distance, and one of them took a break before he came back, Steve Jobs, right? So probably shouldn't have taken a break, but everyone has a ceiling, and I think you have that open dialogue in the beginning. The easiest times when a CEO has to be replaced is typically when it's the most painful situation, which is something that terribly has gone wrong. They've stolen from the company, they've some lack of integrity, something that's black and white, just gone the next day. That's an easy discussion to have. It's a painful one because it's a horrible situation to have your company in. But I don't think there's anything, I mean, it's sort of like saying divorce is pleasant and can be, I mean, it's not. I mean, these are marriages, and in some cases our investments sadly last longer than marriages. So I think understanding that relationship up front, understanding it's a long-term partnership, you're going to be teaming together and having some of those conversations up front and understanding what, hey, if this happens and we have to scale, and understanding if those are the team members that you have. Importantly, one way you avoid that is if a founder does have some limitations in the beginning, you surround that founder with the operating experience that he's going to need, so that, or she, so that you never end up running into that experience.
Yeah, I mean, I would agree with all that. It's important to make sure you're on the same page with your portfolio companies from the get-go. In my own personal sample set, the number is definitely lower than 50%, but non-zero. And I've been in, one extreme was a technical founder who, was the founder of the company, took it through bootstrapping, raising 3 rounds of venture, and taking the company public. All the way to very amicable situations where it was a really young technical founder who never who got the company's seed funding, and we backed because we loved his vision for the business and the talent, and knew he was going to step out of the way. Those are easy. The hard one, or the worst story ever for me was not a CEO that we actually replaced. It's the CEO that we didn't replace, and we should have. But we were cautious. It was a technical founder. We thought all the engineers were loyal to him. We put in a COO instead, and in retrospect, that was a really bad decision. And to show for it, I have a $13 million coffee mug, and the company went out of business. So, part of that is shame on us, right? But I think that there's a perception out there that you get into that it's a common thing that the founders and the board get into a really divisive or sort of toxic situation about the role of CEO, and I really think that is far, far less common than people would think, or as it kind of plays out in the press.
Yeah, I would agree with that. I think that there's a dialogue going on, certainly in the Valley, about protecting the founder CEO and the venture guys really trying to work above board to discuss it as a very important piece of the success of the company. When in fact, I think the reality is the most honest founders who are operating as CEO at the beginning will describe their lack of skills and look for help and offer for the venture team to support them with resources around them, because they honestly want the company, the idea, to be successful. Where the relationship turns where it's ego-based and you've got their own personal agenda involved beyond the company is where things go awry. So I think where we've seen most success is where early in the discussion, even before we've invested, we have very clear agenda around what is it you want out of this company? What is your personal goal, and do you think you could take it all the way? And what might be those shortcomings? And I think that the more honest you are with yourself, the better the situation turns out. But I would agree with Alex, it's where we don't make the move because we are too cautious is where we see problems.
Yeah, I would just say very briefly, it's about expectation management. We have made some founder changes in our companies, and in each case, you hope to have that conversation leading in, manage expectations before you invest, and the partnership of an investor and a founder is always one where you're having the shareholder conversations. We're here to grow the pie together, and if ego is going to get in the way, we'll tend to not get involved right up from the get-go. If they're not willing to look themselves in the mirror and be brutally honest with their own skill set.
Great answers, and thanks for the honesty, guys. I think that's very helpful and revealing. That leads sort of to my next question, which is about coachability. So coachability is a word we hear a lot about. I've heard a lot about it as I've tried to raise capital and had meetings. What's the balance between being coachable but having confidence in your idea? That seems like there's a gray area where you're looking in the mirror saying, we can do this, but then you're also being very receptive to feedback. So maybe I'm very interested to hear your insights into, how you decide how coachable an entrepreneur is versus where that becomes them not having the confidence in their idea or their ability to execute. It seems like if someone's too coachable, they might not be effective because they're taking feedback from too many sources. So I'm very interested to hear your thoughts about, what is coachable enough and what is not coachable to the point where, you feel you can really add value or they're going to be a good investment.
We try to identify that right from the get-go as part of our diligence process in evaluating an investment opportunity. Because at the end of the day, this is a guy or gal that will need coaching regardless of how experienced that they are. And I like it when they ask me more questions about their business plan and feedback than I'm asking them. Right? In other words, that dialogue establishes a pattern of, is this person looking for feedback? Are they incorporating it? Are they recognizing that there's some value that we can bring to the table? So I think it's early. It's one of those things you want to establish very, very early in the dialogue.
Yeah, I would just say, we'll never know as much about an entrepreneur's specific vertical industry ever, but we can often see the forest and have a much broader perspective on company building and what we've seen work in other places and what we haven't seen. And again, I think this comes back to trust and open communication, and hopefully not too big of a board, because that can get in the way of having that time, and exchange of ideas. And we're not always going to be right. We're typically not right. But I think it's having a level of communication where you can share good ideas, get them surfaced out there, and they're running the company. So at the end of the day, it's their job to take those ideas and understand the trade-offs and reject some of the options and make a presentation to pursue it after that. The one thing, at the end of the day, a coach is just like any coach in athletics. They're not there to be your best friend, right? They're there to challenge you. So you're not always going to like to hear from your coach, right? But they're there to make you better and make you a better athlete and a better performer.
The coaching process starts with an understanding of this founder as somebody who thoughtfully came to conclusion around an important idea, and their ability to work through a set of data points and assimilate that into a piece of magic is a process that we would look for in a founder too, around coachability, in that we may not be the only ones with answers. There's other people with answers. So what is your process of gathering insight? We may believe you should go this direction. That's great input. I'm going to talk to 5 other people. We like the methodology. We like your thoughtfulness. We don't always win the battle. We often, as a venture team, syndicate deals with others, as other board members with other agendas, other time frames, and ideally we're all thinking alike, but we're not. You as the founder, CEO, you have to lead the ship. And if you're not, well, somebody else probably should. So the thoughtfulness in your approach of gathering insight, I think, is important of coachability.
Yeah, I agree with all those comments, and also just that, it's sort of incumbent on the founder and the CEO. The dialogue with the board and coaching and advice is two-way, and it's a conversation. And you see very different behaviors from different entrepreneurs and CEOs about how they manage their board, manage the interaction with their board. Some are just completely and utterly transparent. Some are a little bit more guarded and focused on kind of board level discussion, not every day. And so I think you kind of have to kind of have to try and get in the right cadence and understand, how the entrepreneur operates and what the most effective way to give advice, because sometimes it's not advice they want to hear, but at least that they're open to it, and we'll think through things in a thoughtful and analytical manner, and hopefully come to the right decision. At the end of the day, we back teams, and we did an investment because we like the team and we like the market. And ultimately, it's the job of the CEO to process all that information and make a recommendation on the strategy and drive that strategy to execution.
Fantastic. Several of you mentioned interaction with the board and how that can vary. What do you feel is the purpose, and we can break it up into different segments, sort of the different stages of the life of a startup, but what's the purpose of a board? What do you think the purpose of a board is? Let's say sub 500K in revenue. And where have you seen boards do well, and where have you seen boards be completely ineffective?
So,
you don't have to actually mention the company names.
good, I won't. So all of us are investors, so remembering that when we're on the board, we're there also representing ourselves as shareholders as well as directors of the company. And early on, if you wanted to start with there, I would say we TechOperators are fairly geared towards early growth stage companies, and we're always helping build a team, right? I mean, often it's they're taking the money because they've got to expand a team, they're trying to get distribution channels, and we've got a large network of people, we've got access to distribution channels. So our role beyond the governance matters, which we can talk about as well, it tends to be very much involved in operational milestones for the company, helping them get to the next major value event in the company. And it's typically an funding event or profitability or whatever it might be.
Early stage, when it's pre-revenue or early traction revenue, for us, it's, boy, we got to get those early customer wins to help satisfy a couple key things around pain point and ultimate capital equation for the company. And so it's really hands-on there at that stage, and I think a lot of us have great contacts. I think the effort of really taking it all the way and becoming a salesperson for the team in some way is an important role that I have seen pay great dividends over time. As the company matures, boy, we see the board grow. We've got now 3, 4, 5, 6 board members. We've got multiple stage of investors. We break it down into subgroups where there's groups working on various aspects of the business with the idea to continue to drive and be catalysts for operational speed of go-to-market and marketing success and partnerships and all kinds of things, but kind of break it down with the board isn't actually too much because we can be pretty overwhelming. Just getting ready for a board meeting in and of itself for a team that's small, where the head of marketing, the head of products, the head of sales, and certainly the CEO and the CFO all have to do these regular presentations, and there's some work involved in all of that. When we're early stage, we're meeting once a month with the board. And that level of effort is intended to be an accelerator, not a detriment to their own efforts. So I think there needs to be a balance there as well. But as the company matures, we move to quarterly and try to back away. So.
Yeah, I think a couple people have either mentioned or alluded or mentioned specifically the size of the board. And I was working on a term sheet this morning that is a 7-person board, and I was kind of dreading it. I was like, how can we make this smaller? Because it can get a little bit unwieldy, and in this case, and in a number of cases, I'm interested in kind of plumbing-centric things, real infrastructure. So there's often strategics around. Having strategics on your board can both add a lot of value and also complicate matters at the board level. And so those are a couple of things that I think are important to take into consideration. And there was one other thing that I was going to say, but I forgot. Somebody else can answer.
I was just going to add to your first question, what's the role of the board? I mean, that's one of the very specific jobs is you have a fiduciary responsibility, you're providing oversight, governance, and you represent the shareholders. I think as it pertains to sort of the day-to-day additional job duties, you ought to view it as a part of your broader team. And some of the best CEOs, I think, recruit board members with different skill sets. And it's great, you don't always have that ability, depending on what firms or strategics or independents that are involved. But in particular, as it pertains to independents, you ought to be looking around and seeing what skill sets are missing from the board that you might have, whether it's the idea of the customer or insight into the customer, whether it's recruiting or business development. From a partnership perspective, we view the help that we give to the companies in the same way. There's folks in our firm that are really good at tech, and they'll help with a tech roadmap, and whether they're on the board or they're not, we'll deploy them into the company to offer that help. We'll do that on the business development side, and as a result, one of the reasons we stayed small is so that we can all get involved when other companies need help on the company building side. To your question of when do things go wrong, size can be a challenge, especially when, and sometimes when there's strategics, it can be a challenge, especially if there's a lot of business development activity going on and you're wondering if the dialogue in the room is really the dialogue about what's best for the customers, what's best for the strategic investors, or really what's best for the company and the shareholders. I think one of the things that often leads to that is information asymmetry. And that can happen because either a board's too big, a management team's not sharing enough information, or frankly, you have lazy board members. Yeah. And I'd say the latter is probably the most common case, where they're either on too many boards or they're just lazy, and they don't do the work, they don't read the pre-read, they don't add any value. And one of the things I've seen CEOs do is get into the habit of recognizing board members, and in one case even giving an award sort of every quarter to the board member that added the most value, and basically put them to work for the company. And you can get a lot of value out of that if you do it right.
Let's dig into that a little bit. So I mean, you mentioned Steve Jobs earlier, and famously when he returned from Next, he pretty much established a new way of working with boards, and that it was pretty evident to everyone he was completely controlling the show. How have you seen, the same way that there's a natural need to replace some founding CEOs because the skill set that's once very valuable becomes less valuable, how do you deal with the board members who are very relevant at one stage and no longer relevant? Or what do you think is the best way? Let's say there's a board member that is adding a lot of value at a particular stage. Let's say your investment team, you've partnered with a couple other groups, and that individual is no longer driving that value they were. How do you deal with that? How's that conversation? Is that something the CEO leads? How does that conversation come about?
So, yeah, that's always can be a difficult subject to deal with. I mean, the first obvious angle is the one-on-one dialogue between the CEO and that particular board member. If there is a concern of not being productive to the broader mission, and trying to get alignment there. But if it's an investor, board member as opposed to an independent, they're representing their firm, and usually that doesn't change unless you have another funding event, and in which case the CEO might whisper in the ear of the new investor, this guy's not adding value, and sometimes there's a change associated with, usually a change with the board makeup in another funding event. But it's usually apparent, with an independent director, it's usually apparent to the rest of the board, and in that case, the CEO is usually the guy who brought him to the board in the first place, and those changes are easier to affect than the investor board members.
I think smaller problems can be dealt with just by open, hopefully you have build up trust and a level of communication. You can say, Kevin, you're being a knucklehead, But if that isn't the case, the easiest way is to get Alex to kick off a couple people off the board with a new term sheet, right? I mean, that does happen, as Glenn, as you suggested. So I think that's one of the easiest. The one, as a practical matter, if they're an investor you're stuck with, if you will, and you think it's a systematic problem, one of the things I've seen effective, in particular in bigger boards, that you can name a chairman. You can also do board reviews and gain the help of the other board members to sort of make sure that there's good decorum and good behavior and productive behavior. One particular board, we have something like 12 people in the room, and the CEO has a communication challenge with the board, which would have been the same if there were 3 people in the boardroom. But now that there's 12 people in the boardroom, including strategics, it just makes it worse. First thing we ended up doing was we brought in new money from a new investor that helped change the dialogue of who would be in the room, but it happened to be someone who's been doing this for 35 years that I knew, and we could say, you know what, I think he'd be a great chairman. And then he ended up crystallizing the view. Basically all the information ended up going through the chairman when it came to very crisp direction that needed to be shared.
Yeah, I think the other thing where you have a lot of leverage and where it does change over time is, of course, the independent director. And, the board is composed of, representatives from the preferred stock, which is usually people like us, representatives of the common, which is usually the CEO and or somebody else, depending on how big the board is, and then the independent. And the independent could be brought to the table by the investors, by the founders, and I think it is a good point that over the maturation of the company, you're going to want to get different things out of the independent. And I think too often, actually, we kind of, if we do a deal, we're like, oh, there's an independent slot, we're going to, we'll fill it once we close the round, and then, there's a million other important priorities, and so sometimes that, that gets pushed down in the queue. And actually, it's a really important, and if you can find great independent directors and be thoughtful about what it is you're looking for, and be honest about what skill sets you would like to augment in your team, that's really important, and that can change over time. So, you might be looking for somebody who's really go-to-market centric, and then the other, real obvious one is, you want to go public, so you need someone who's been a public company CFO to run your audit committee, and those people, can extort private startups for lots of stock options because they are in high demand, but it does change.
I was just thinking, who is it who's IPOing in a week or two, and their CFO, Kayak's CFO, just left. So it's ironic you mentioned that. New hot startup he's going to, but I guess he left with lots of options at Invest. Let's change gears a little bit. I'm really interested to hear your thoughts about the pitching, the very beginning stage, what these companies are doing tonight. Kind of a couple different areas. Sometimes you hear that VCs like to see a trend. But then other times I hear about startups that come out of stealth mode or sort of in stealth mode. And the way I've seen VCs operate is sort of at two speeds. It's either things move very slowly, or there's a tornado coming and everyone's getting out of town and you've got to act very fast and there's just a lot of rapid movement. What are your thoughts about seeing a trend and having exposure to a company over time versus being exposed to an idea that seems very, very, very hot and you have to strike very fast? It seems like two ends of a spectrum. And maybe that's too vague, but maybe you guys could comment and we'll just talk a little bit more about sort of the pitching.
They are two ends of the spectrum, Dave. I think you like to take the time to get to know a team when they don't need funding, right? We invest a lot of our time in getting to know prospective young companies and management teams, and with an eye towards, as they hit some milestones, they'll need funding and perhaps that'll lead to something that we invest in. Occasionally, you get a really hot founding team who've been successful before in a space that you focus on as an investor, and particularly well, and you want to strike quickly, and you have to balance those, right? We wouldn't strike quickly in a market space or a team that we didn't know, right? We wouldn't take that risk. Some investors will, but I think you're more likely, if you hit their sweet spot, they're going to jump in.
Mm-hmm. I think it's very similar. I mean, we went through a change as a firm about 3 years ago. Valhalla was started out as a regionally based firm, really in Maryland, Virginia, DC, and then Mid-Atlantic sort of became defined south of Canada, north of Florida. But just with the changes going on in the venture industry, I mean, in my short time in the industry, I think we've gone from something like 1,700 firms to 400 active firms, probably going to get smaller. We basically saw the world as you either needed to go big and global, close to $1 billion funds, raise a micro VC fund, which I think arguably only works in consumer internet. I think the jury's still out there, or go national, but have a very strong sector focus. And so as a firm, we made a very, it was a pretty big pivot for Valhalla about 3 years ago, and we made some changes as a result of that. And what it's given us the ability to do is invest anywhere in the country at any stage. The smallest check we'll write is $100K in Atlanta. Our last investment, I think, is going to be one of our most successful. In Fund 2 was a $500,000 investment to Dave Wright, a company called SolidFire, which Alex has made the market pretty exciting in the last week because one of SolidFire's competitors, and there's only one other, just sold for $450 million. Is it 450, something like that? Reportedly, you can't
actually tell you that. You can
Try to get it out of him.
But you know, it's a sector we know a lot about in storage, and so all of us are spending time in sectors we know a lot about, so you can strike fast, but also so you can build long-term relationships. My partner Charles has been investing in a relationship with the 3 engineers from Isilon that had 90% of the patents. And they just spun out, and we ended up seeding around in that company out in Seattle. And you know, now everyone's screaming and wants to get involved, but that was a 1.5-year project for us that really came out of very deep relationships we were forming with jockeys that we thought were going to be great in the storage sector.
So the bottom line is you got to invest in the merits of the deal itself, and not the trend or not the syndicated momentum that's around it, the tornado as you described. But people are people too. So we find ourselves being pulled into very interesting deals where other investors have started the due diligence. We don't know the people as well, but it's moving along. And luckily in a partnership, there is a partnership decision process that there's always a sage or a straight man in the group that will say, wait a minute, where are we going with this one? Because we'll get caught up in a particular opportunity. And I often tell entrepreneurs that the partnership decision process is indeed that. You need individuals to be your ombudsman in the building, but then there's 5, 6, or 7 other partners who are also going to make the decision, that are going to look at it differently and maybe not with the same kind of rose-colored glasses. So we try to say we're not following the trend, look at the merits of the deal. The merits of the deal should show inflection. As an early stage investor, we look for these pivot points in the inflection of revenue and market traction, and try to just focus there. So we're not perfect.
Yeah, and I think Kevin made a good point. We spend a lot of time, Battery has a heritage going back to the Yankee Group in market research. That's actually where my first job was. And so we have a very market-centric thematic point of view in our investment thesis. So we try and think about the markets that we are excited about and want to invest in, and go master them and go know everybody there is to know in them, and get to know entrepreneurs before they want to raise Series A. That doesn't always work. Sometimes it does. And the reality is that in today's environment, it's fairly frothy in many sectors, not just in consumer internet even, but even in infrastructure. And so the decision time frame that you have these days is getting compressed. And so that requires, hopefully knowing something about the market before you meet the team, and also having the conviction to, even if something looks really good and you're not done with your process, having the discipline to back away from not doing the deal just because it's hot and frothy and, they have 5 term sheets and you want to be the 6th one by Monday. That generally doesn't end well. Sometimes it can. But I think it's just about being disciplined as an investor and running through your process, and if it can work to the time frames of you as the investor leading the deal and to the cadence of your partnership, then go for it. But sometimes it just doesn't work out like that.
So one more question on sort of the initial meeting with entrepreneurs. I personally, embarrassingly so, spent probably way too much time on my pitch deck thinking that, right font size and Guy Kawasaki 2018-10 rule, and this angel guru says this rule and 5 slides, and Fred Wilson likes 4 and a demo up front. If you have, what do you guys like to see? I mean, it sounds like I'm hearing a lot about the team and the market. I mean, have you invested in some guys or girls who presented you with a horrible presentation but had a really good product underneath it? And how do you think about the pitch? Really interested to hear your thoughts.
So first of all, you had one of the coolest pitches in your company. It's one I had with the animation. Right? So kudos to you, Dave.
Thanks.
But at the end of the day, we have invested in companies that gave really shitty pitches. We have, and so it's really so you go, okay, let's. Oftentimes it's a technical founder who isn't comfortable pitching, hasn't mastered PowerPoint skills, so that's okay. If you can cut through to the facts and if the business is sound and the team is sound, the pitch is less important.
Mm-hmm.
Yeah, I wouldn't kill yourself on the pitch on getting your PowerPoint optimal. We've invested in entrepreneurs who come in and just come in and have a dialogue even. You don't even have to show slides. We can have a conversation about your business. I think you'll find that also gets the potential investor more engaged because we sit through a lot of PowerPoint, a ton of PowerPoint. And sometimes there are patterns and you zone out. And I think, if you, as an entrepreneur, I think it's a great strategy. Ditch the PowerPoint, come in, have a conversation. Is there going to be a whiteboard? Okay, great. We can whiteboard out to how this is going to look and what it's going to do. And so I wouldn't spend tons of time, if you're going to do it, you should do it and make it look good, but, it doesn't have to be, every single page with builds and animation and this and that and the other thing. Just focus on your value proposition and what you're going after, and realize that, for us and for entrepreneurs, this is a time, we're all time limited. And your goal from that first interaction is to get to the next interaction. Because at that point, it's binary. Either we're going to spend more time with you, or you're not. And you want to be on the right side of that fork in the road.
Yeah, good point. I love it when they come in and just nail the problem statement. Right out of the gate, it's clear that your understanding of a problem in a market that perhaps others haven't seen the same way you do is so well understood. You feel viscerally about this. You understand it. You've done market research. You're scary knowledgeable about the space. And then you offer up your solution. That's a dialogue. You wouldn't be in the building, or you wouldn't be talking if the team and all the other underlying merits of the size of the opportunity, et cetera, didn't make some sense. So we wouldn't be talking probably unless there was some earlier introduction. But when I finally get the dialogue, it's, boy, what are you trying to solve? And how well do you understand that problem? How deeply do you understand the problem? And scare me a bit with how much you know about it. So,
I would say I don't like it when they say, this is how we want to see our. Putting an entrepreneur in a box is a very bad idea. It's sort of the reverse of what they're there to do. So at the end of the day, I think you need to be able to tell a story. And however you feel the best way to tell your story, tell it. If you can't tell your story, but you've got super cool technology, we might still invest in you, but we're then going to go find someone who can tell your story, because if you can't tell your story, you probably can't sell it. But I think, and there's folks, by the way, that don't tell us a story and don't do any of that, and they're just either repeat jockeys that, Scott Ferber from advertising.com walked in and said, I'm going to build the next Hulu. We're like, but there's Hulu. Yeah. And then, 6 months later, he comes back and says, I'm cutting everything, I'm pivoting this way, and he's off to building a video ad tech platform. It's probably one of the fastest growing and could very well return, if not double our fund, in the DC area right now. And we all sort of just said, that's Scott Ferber. We don't care what he's doing. We're going to keep investing in Scott Ferber. That doesn't help for the first-time entrepreneur, but I think Scott was always really good at figuring out how to very quickly identify what his story was. And when he couldn't get his story, he knew he hadn't figured it out yet.
Great. Well, I think that's all we have time for. Glenn, Kevin, Gamiel, Alex, thank you guys very much.